think you should, you know, you can't time the markets. You can't time the real estate market. You know, in 2008, when the bottom fell out, I had about 60 houses.
Mm-hmm.
People kept paying rent. I mean, I deal in apartments and in housing. I deal in kind of your bread and butter houses, plumbers, electricians, Starbucks workers, retail workers, fast food workers. You know, my average house rent is $750 a month. So I don't go for the high end stuff. I like the bread and butter. So when the economy tanks, most of those people have some form of employment. And, you know, you can look at charts in 2008 when the economy fell and the housing bubble burst, and you could see the chart. Housing prices went like this. Multifamily prices also kind of took a turn, not as bad, but the cash flow stayed like this. So you couldn't sell your multifamily because the value wasn't there, but they kept making money. So if you were an investor in multifamily, you kept making money. People,
because if people lose their house, they still have to have a place to live. I mean, you're absolutely correct. And you're not the only one we talk to, but
that's why we like C properties. So you got 4 classes of properties. You guys might know this, but the A is going to be your best apartment complex in the nicest area next to the nicest mall, higher rents. It's going to be your professionals that choose to live in an apartment, could live in a house if they want to. B's, plumbers, electricians, higher class teachers, firefighters. They're going to be not in they're still in good areas, but they're not going to be the A areas, and they're going to be built in the 80s, a little bit older property.
Okay.
The A's are going to be built, they're brand new. They've been built in the last 5 or 10 years. Have all the amenities, have all the great stuff, the gray flooring and the gray countertops, all that cool stuff. C's is going to be your workforce housing. That's going to be your retail workers, your plumbers, electricians, your fast food workers, stuff like that. And then D is your Section 8 properties, your war zones you don't want to go to at night. They're scary. The government subsidizes your rent. So the only place for the C, so when the economy tanks, A's go to B's, B's go to C's. C's can't go to D's because D's are basically, they don't want to live there. And then D's go to, there's mobile home parks, and then you're homeless. So that's basically
how that works out.
Yeah. So we like C's. C's are not war zones. They're good. You can make them nice, good, clean properties. You can improve them and do a lot with them. But they're the ones that are going to be the most stable in a downturn economy. So for your folks out there that are scared of the economy and scared of the worst place you can have your money in a downturn economy is the stock market and the bank. Okay. Those are the 2 worst places you can have. Sink your money in some good C-class real estate, whether it be single family houses or whether it be multifamily. That's where you want your money. It's stable. It's not going anywhere. They're not building any more C properties. Everything I build now is A's. You can't build a C property.